Hello, everyone. Welcome to this presentation, another Las Vegas update. And this is SeeWing Yee from the Yee Real Estate Network. And as a network investor, we take our investors, mostly from California, to invest in out of state, whereby we feel that there's an opportunity for cash flow and appreciation and buying whole long term. So today we're going to talk about multi-units in the Las Vegas hot market. And once again, I have invited Mr. Glenn Plantone, who is based in Las Vegas for many years. He has done many deals for out-of-state investors for many years. He has helped hundreds of investors. He has helped some of our investors off and on for a number of years. So he comes with a very good track record. Mr. Glenn Plantone owned multiple properties throughout the country and in Las Vegas also. So he's a licensed broker. He does local real estate in Las Vegas for owner occupied buyers, but he worked with real estate investors, which is kind of rare. So he has some great opportunities for us right now, and multi-units, which is 4 units and below. Basically, if the 4 units and below, you can still qualify for 25% down under the favorable Fannie Mae lending guideline, typically, whatever, 3.8%, whatever, amazing interest rate. But if he's going to talk about more than 4 units, that means it's sort of a commercial lending, a little bit more challenging, but still, you can still doable. It's not within the Fannie Mae lending guideline, but it's still 25% down payment, maybe slightly higher interest rate, but still it makes sense. But let's hear from what he has to say. I can't wait to hear what he has. We got going. So, Mr. Glenn Plantone, take it away, my friend.
All right, thanks, SeeWing. So, we've talked previously about single families in Las Vegas, and that's where I've concentrated in primarily. For myself, I've bought and sold over 400 properties here in Las Vegas alone. In other markets, I own about 30 or 40 properties here in Las Vegas, maybe 30 or so are properties that I hold on to, and the other 10 are in the process of being flipped. Some are commercial, but the majority is single families. But we're also doing a lot of multifamily right now too. And that's been very interesting. We seem to get a lot of attention. A lot of California investors want to buy multifamily, not just single families. We know the Vegas market is challenging right now because inventory is very low, prices are up, rents are way up right now. Also, a lot of good articles on rents that I do Google alerts every day. And this article just came in yesterday on the rental market of Las Vegas, and the rental market's on fire. So it's really a great market to be in. If you own property right now, it's going up, rents are going up, that's all good. But I think an area of opportunity is going to be in multifamily. When I speak multifamily, I'm talking about an area outside the downtown corridor. I'm going to call it Naked City, which is referred to. Some people call it the Gateway. If everybody has been into Vegas, you know where the Stratosphere is. In and around where the Stratosphere is what we're talking about. So what's happened there is Elon Musk is coming in and putting this loop, the Vegas loop coming in. It's going underneath the street on the Las Vegas Boulevard. So it's going to connect downtown with the convention center. And it's going to be great because anybody who lives in that corridor literally can walk to Las Vegas Boulevard and catch some sort of transportation. So they don't necessarily need to have a vehicle. And vehicle, of course, it's always tighter in the downtown corridor for parking. But that's good news, is that they don't need to have a vehicle and they can walk. And most of those people work on the strip, or, there's so many jobs within a 2 or 3 mile radius. It's phenomenal. And with new hotels and whatnot opening up, a lot of opportunity. So just recently, I'm buying a duplex myself with my partner, and actually we're going to convert it to a 4-plex. It simply is a 3-unit downstairs, 3-unit upstairs. We're going to convert it to 2-1, and we'll get about $4,000 in rent for it. We're paying $400,000, so it's about $100 a door if you're looking at typical financing of duplexes or 4-plexes or quadplexes. Now, this duplex is more expensive than most duplexes that I would normally pay for. However, again, this has got really terrific rent, and it's a big duplex. It's like, I think it's 2,800 square foot, and there's capability to add more square footage to it also, because the present owner added square footage already. We're just going to go up and add a whole nother probably 250 square foot to it. But my point is there's a lot of opportunity. So we're getting a lot of investors coming over from California that want to buy fourplexes and bigger. Now, most of what you're seeing in this older part of Las Vegas that I mentioned, the Stratosphere area, is going to be anywhere from 4 duplexes up to maybe 20 units. There's not a whole lot that are bigger than that. There might be, but that's the advantage, because a lot of investors don't want to come in their first time and invest and buy a 300 unit. They don't have the capability to do that. And in this case, if they can buy a 4 unit, a 6 unit, a 12 unit, they've got the ability to do that. And there's a lot of older buildings that are in pretty bad shape, so we can get them at good prices. One that we just missed last week went for, I think, 700,000, and it was a 12 unit. So if you look at the numbers real quick, if you divide 700 by 12, what do you get? 58 a unit, which is pretty good. Now they're going to need about 15 to 20 per door, but still, bring that up, it's going to be 75 a door, which is under the 100 a door that you're seeing. And that's kind of a barometer right now is what you're looking at in Vegas. So if anybody's got interest in that, now's a good time to look at it. You also hit it on the head as far as financing. You're absolutely right. The duplex we're buying, we're getting 4% interest, which is good. It's 30-year fixed 4% interest, not a variable rate. Interest rates are so low, I discourage people from getting a variable rate. I mean, it's so low now, lock it in. Sometimes they'll give you 25-year, 20-year on a commercial multifamily, but we're getting 30-year fixed on a 4% loan. So, and with 25% down, like you also mentioned. So you hit it right in the head with that. We've got lenders in town that can do it. If you've got good lenders, no problem. We generally prefer to have a local lender because they know the local laws. It's a little bit easier. And I've got some lenders I've done really good stuff with, and they can process you pretty quickly. So if you've got a good credit score, you've got the 25% down, and you're ready to go, you're going to walk into cash flow. Now, some of these are going to need some work. Recently, in the last 3 months, we've sold a duplex. We've sold a 6 unit that we're going to add a unit to make it 7. We sold a 4 unit that we're going to add a unit to make it 5 units, and another 5 units. So that's just in the last 3 or 4 months. So we're starting to get more activity. I was typically not into selling a lot of multifamily, but I really like this area, number one. Number two, the prices are pretty low. The interest rates are low. And there's great opportunity, again, because they're growing in that area. They're revitalizing that downtown area.
Glenn, are you the only one that have access to this type of opportunities, or there are some competition out there, or what this kind of potentially renovated type of properties? Are they in a multiple listing service, or are they in an off market type of opportunities?
No, great question. And no, many of these are listed in LoopNet or CoStar, which are the big commercial listings. Many of these are off market, which is good too. And that's where we find a lot of good ones off market, because David, my partner, lives right down there in that area. And so he's every single day, he's on his bicycle, driving around in his car or bike or walking. So he's seeing the opportunities. He knows the players. And we use a lot of skip tracing service. So we'll reach directly out to the owners. Many of the owners, of course, live out of state, and they're not really sure what they have, or they've owned it for quite a while. They don't know what it's worth. They want to get rid of it. It's, these are old units. In some cases, if they're not maintained, they're going to need a lot of maintenance. And in our case also, and I didn't mention yet, but I'm sure you've mentioned it before, but we also property manage. We manage about 300 units right now. So it's very easy for us. The guy that just bought the 4 unit, that's in pretty good shape. So no real problem. We're just going to convert one of the storage units into a 5th unit. The other guy that bought the 6 unit, different story. That one needs a lot more work. So we've got to put our contractor in there, and it's going to need work. But typical rents might be in the 700 range when we bought it. But after we go in and stick 10 to 15,000 per unit in, now rents go up to 1,000. So we'll get that back in a couple of years. But not only getting it back through rents in a couple of years, if you're looking to flip the property or resell the property, just adding that rental value takes the cap rate to a level to where it's a much more desirable property, and it can be resold for a profit. If somebody wanted to just come in and flip a property, they could do that too.
When you mention, okay, let's talk about the cap rate. What are the you and I know cap rates, but a lot of investors may not fully understand the definition of the capitalization rate. So what are the typical cap rates you expect to achieve?
Well, good question. And of course, it depends. Again, like I said, when you're buying it. If you're buying it, you might get a fairly good rate of return on a property. At this point, it could be 7 or 8%, which is a good rate of return. But it's, again, in a bad area and it needs a lot of work. So it may be difficult to resell that because it's harder to sell a property that needs maintenance, deferred maintenance. But once you jump in and put some more money into it, your rate of return may go down from a cap rate point of view, may go down a little bit, but the risk factor goes down also for the buyer. And so, as you know, in California, cap rates might be 3 or 4% for investors that are buying. When you come over here and you can get 7%, you're getting a much better return. But the California cap rate of 4% might be a building that's been gentrified or rehabbed and it's in really good shape. So there's you have to understand with cap rates, it's the rate of return, but it's also the risk factor you have to take into account. And most of the stuff we've got, the buildings are built in the 50s to 60s, early 60s. That whole area was built. And that's why they call it Naked City. A lot of people don't know where they come up with that. It's when they built it in the 50s, the showgirls used to lay out nude. And that's how they got the name, because the naked girls would be laying out there and they called it Naked City. Now they're trying to change the name to the Gateway, and I understand that reason. But at the end of the day, this is an area that's very old. It was built in literally the 1950s and 60s. So it needs a lot more maintenance and work to bring it up to speed.
So you see this neighborhood potentially in the future will go through gentrification, and then in the future it will be a better neighborhood. I mean, right now maybe a C or C+ neighborhood. Maybe you can try to up it to a B- neighborhood for the foreseeable future. Is that?
That's exactly right. And the thing you have to understand, if you look at it in the map and just pull up, I'll give you an example. The one I just bought is 240, or what I sold, 245 West Philadelphia. So if anybody wants to Google that, 245 West Philadelphia. David bought the unit right across the street. There's a triplex and a fourplex across the street, which is, I think, 246. And then 245 we just sold. So if people want to see where that's located, it is literally less than a mile from downtown. It's less than a mile from some of these new hotels that are being built. So even though the area is still a little bit old and decrepit, it's coming around, it's turning around, as we said. And so as they turn these buildings around one at a time, all of a sudden, all the bad, the old is getting pushed out. And the newer people are moving in, the people that are either the younger millennial type people or the folks that live close and work in the hotels. And so it makes it really nice that we're turning the whole area around by doing that. But it's so close to everything. You can't imagine if you were in New York City or San Francisco and you're a mile away from where all the jobs are. And that's where you are in Las Vegas. This area has really been ignored for the last 30, 40 years. And people are starting to take attention to it, and that's what's happening.
So Glenn, because of your unique expertise, because you know how to look for undervalued, up and coming neighborhoods, and plus you have a past experience, I have to guess that your colleagues, your fellow real estate brokers in the Las Vegas market, most of them are does not have any specialty to venture into this unique niche market, if you will. And no, the other realtors in Las Vegas, most of them are newbies. They don't know anything about multi-investing. They don't know anything about renovations. They just focus on the cookie cutter owner occupied type of first-time homeowners to want to buy in Las Vegas, whatever. So are we to assume, again, because of your unique skill set and your connections and your network, that you could bring this type of deals to the investors where most real estate people in the Las Vegas?
No, it's a good point, because I've done so much in my real estate career. Like I said, from the single family homes to the multifamily to commercial to owning my own brokerage with lots of agents with property management division. So well-rounded. That's all good. But having done 400 flips, having done conversions, and having done all this makes me a little bit different than a typical realtor. I totally agree. I mean, somebody can go find a realtor all day long, and that realtor can look for properties for people, but we're buying more than just properties that are listed. Again, we're looking at properties off the market. We're looking at people that are buying and selling. We're dealing with the commercial investors instead of just a typical realtor, and you're right, there's over, I think, 14, 15,000 realtors in Las Vegas, and the average realtor does less than one deal a year. I'm doing typically 5 or 6 deals a month, just on the side of buying and selling. I buy for myself. We're listing properties all the time for investors. Many of the investors in my property management have decided to sell, which is not a bad idea because the market's trending upward. So it's good to sell along the way. Yeah, if they wait a little longer, it's going to be worth more. But at the end of the day, they're doing well. Many people bought properties back in 2009, 10, 11, 12 at the bottom of the market, and they've doubled, almost tripled in value.
Yeah.
So they're doing well. But yeah, so I'm well-rounded in that. I'm very, very busy, obviously, with what's going on, especially when I have new investors coming to work with me. But I've got a small team that works well. My sons work with me. David, who you met last year when I came up, works closely with me. We've got about 15, 20 agents here in the office. And so I typically will work directly with the client. Like Sunil yesterday, we had a nice chat with. So I spent 45 minutes with my son and Sunil on the phone. So we have an idea what he's looking for. Right. And then we start a search. We make sure he's qualified. We make sure the money's right. You've got qualification, you've got proof of funds, and then we'll begin looking for properties. So we don't necessarily just start sending properties to somebody out of the blue. We want to make sure that person's ready to buy. They're qualified, and then we start looking and going from there.
Definitely, exactly. I know exactly how you feel. So let me see if I understand you correctly. So with respect to duplex and fourplex, you were able to find those deals, not that many, but enough to keep you busy moving forward. And those 2 to 4 units are require some renovation. Not that much. Is not a total gut job. So for individual investors that are qualified to buy this duplex or fourplex in the neighborhood you just discussed about, not only they need to put 25% down payment, they need to out of pocket. In addition to that is the renovation costs. Of course, you guys have a rehab team to do all that for them, so they can my investors could do it remotely, and you just you will have a team in place to do everything from beginning to the end. So with a 25% down payment, with like per door, maybe 5-10 grand average additional renovation cost per unit. So at the end of the day, when you fully rehab the property and then make it rent ready, the rent should be you should be rented each door, each unit to a fair market value. So at the end of the day, for example, for $400,000 property, a fourplex that is, if it rents for $4,000, all 4 doors, I mean, you and I can do the math. I mean, 25% down payment, the cap rate will be 7 or 8%, and the monthly net cash flow, I would say, monthly net cash flow after all the deductions, I would say around $1,000 per month.
Yeah, even more on that duplex we bought. It's going to be about $1,600 a month. It's going to be about $800 a piece for me and my partner on that one. So yeah, you hit on the head. The thing about, talk about rents for a second. So rents, as I said earlier, are going up. Rents are crazy going up. So usually what we're finding in this corridor is that studio units, and we're seeing studio units in the 300 to 400 square foot range, are renting for about $800 to $900, which is really strong. 1-bedroom units could be $900 or so, and you're finding 2-bedroom units at $1,000. Now, the units are typically going to be studio 1 or 2, not a whole lot of 3 units in this area, but with 1-bedroom, 2-bedroom units, you're seeing as strong as $1,000 a month. So even if it is $100,000 a door and you can get $1,000 months rent for it, that's that old 1% rule and putting you in a good position. Of course, if you're buying usually multifamily, usually you can get lower than $100,000 a door if you're buying a 6-plex. Like the 6-plex we sold recently was it was $520 for the 6-plex that we're going to add a unit to. And then the 4-plex we just sold, which is going to be a 5-plex, was $469, I believe. So, again, you add the unit, you're about $100 a door. That's roughly where you're at. The bigger you go, usually it goes down a little bit under $100,000.
Yeah, okay. I was going to ask you the question about the multi-units or more than 4-plex. Given you just told me that the 5 or 6-plex is only 500 to 600K, yes, you need a commercial loan, no problem, understand that. So having said that, I mean, you and I would pretty much agree that all you need is one investor to buy not only the up to 4 units, but even the 6 to 8 units, it only costs 500 grand, whatever. So you most of the time, because California investors are so, have the financial capability, all you need is one person, one investor, get into this kind of deal. I mean, from time to time, you do, ask for partners, but for partners, you most likely, I have to assume, you tell me about my take on it, is if you're selling a 8 unit, 10 unit, 15 unit, if it costs about $1 million or 1.2, whatever, you might be willing to bring in a partner, one or two or three people, combine their resources to.
Right, and what happened on the 6 unit we sold, there was two partners, but they wanted to pay cash, so they both put in 225 each or whatever the number was. So, and they're putting in the cash for the rehab. That unit was in worse shape than the other one. Like I said, the 4 unit, because we don't need to do anything other than add the 5th unit, so very little maintenance. We're just going to go in most cases, raise the rent. So, like with the 6 unit, 2 of the units were in pretty bad shape. So one of them was. We went in immediately and just started rehabbing. I think the budget was like 12,000. There's another unit upstairs. So we asked that tenant to move out because it's in bad shape. So we're going to rehab it, and then we'll either move him into another unit or move him out. So yeah, we're walking into a situation where the cash flow is not as strong as we'd like to see it. But after 6 months and every unit's been rehabbed, where we moved somebody at 800 from this unit down to 1,000 for this unit, or if they don't want to pay 1,000, they move on, and we get a new person for the 1,000, and we raise rents, because everybody, typically when you're buying in this area, most people are on month-to-month rentals, which is good for us because we can raise the rent immediately. If they want to stay and pay the rent, great. If they don't, they move out, we rehab the unit, and we raise the rent, and we'll get the rent once we raise it.
Yeah, speaking of raising the rent, not only in Las Vegas, there are many markets throughout the country, from what I've seen firsthand, is that the rental rates has increased dramatically for obvious reasons. Because there's so few homes out there to buy. A lot of people that make good income, they are relegated to renting, and they have good income, and so therefore the lack of rentals, right? There are lack of people, single family homes, and even multi units for renting. So many renters out there, they are. It's like a bidding war for yep. rentals. So you can, as a landlord, right now you're able to drive up the rent. So therefore, Las Vegas is a recipient of the amazing real estate rental rates boom, if you will. Yep.
So well, one of my Chinese buyers actually just emailed me Friday, and I looked at the rental rates and the sales, and I got back to him. He was pleasantly surprised how high the values had gone, and also the rentals. And the 2 rentals that he has were both now on month to month because they've expired recently. And I said, hey, if you want to sell, these are your numbers. And if you don't want to sell and want to stay, great. And both of them went up about $200 to $300 a piece over the last year or two. So he's like, no, I want to keep them. So we're going to raise rent. So it got me thinking, and most of my rentals are pretty current because I buy them and I keep on top of them. But I decided for myself, because the rental rates have gone up so much in the last year alone, that I'm going to look at all of my 30 local properties and find out who's on a lease, who the leases that are expiring, and just do a quick audit, because rents have gone up so much that, I mean, if I raise $100 a piece times 30, that's $3,000 a month, and just extra income that I'll make just from raising rents on everybody. And the other piece of the equation is, like you said, there's really no inventory. So they're forced to stay. They can't move. You could raise them $200 and they can't go find something else because there's nothing else out there. So they're almost forced to stay. And it's unfortunate in that regard, but it's good for us as investors because we can get the rent.
Yeah. Well, I have to say, I mean, the big picture is right now is the best time to be a landlord. I mean, it's just, we're getting high rate of return, high capitalization rates in a market, as I told you a few months ago, before we reconnected, I thought for the past 8 years, Las Vegas, the cash flow market is just not happening. But because of the rent to value ratio, it's just there's a disconnect. But because of what's going on in the past 18 months, pandemic and post-pandemic, I mean, it's a massive rise in rental rates, massive rise in in home prices and limited inventory. The whole ball of wax. Anyway, so So it appears that moving forward, that you have not a lot of multi units in this type of kind of product, but you have enough to have a consistent inventory. I mean, few at a time throughout the year, throughout the remaining of this year, enough to trigger more investors for my
Right.
investors.
Well, that's the good point is right. I used to do this 10, 12 years ago. That's all I did was deal with investors coming in, and I was entertaining them and buying properties. I don't do that as much anymore because I've got my own properties and my own thing going on. So I will still work with investors that come in. But the good news is we don't have a ton of traffic. So in other words, I'm not going to get 10 guys from you call me tomorrow all ready to buy something, and then I'm scrambling to find them something.
Right.
I might get a call a week, and we talk to that person and we qualify them. And if they're ready to go, we'll work with them individually to find them something. And if we find it, great. If we don't, that's great too. But we're going to look and work really hard with that investor. And that's the good news. Your investor database is big. You've been doing this for years, but we typically don't have tons of people, calling all of a sudden saying, hey, I want to buy a fourplex. I want to buy a sixplex. I want to buy a duplex. And so we can work with them pretty aggressively with my team that's here, and we can generally find them what they're looking for.
Very good. Okay, then. Glenn, I think I have a clear understanding. The opportunity is really good. Duplex to fourplex, even multi-units beyond 5 units. So the recap to me is the cash flow is very, very high, 25% down payment. Some investors have to pay some additional costs to fix up the property, but is right now it's undervalued, has a lot of future potential, even appreciation potential, not just very good cash flow down the road. And also, my takeaway from talking to you today, in terms of exit strategies, the investors could, buy the property, fix it up, and then flip the property for a profit, even if they want to. But again, buy and hold strategy is also really makes sense as well. So some good exit strategies. Yeah, I mean, really is opportunity to make good money in this very challenging market. So working with you that have a niche market like this, and is a very reassuring. It's very, very rare to find. So do we have a kind of one for you, Glenn? Last minute.
Just to wrap it up, and you said it because I hadn't spoken too much about appreciation, but I truly believe we're in for a couple year run upward. Inventory is low. Supply chains are low, like you said. So you can't go to Home Depot and buy because they're low on product. I don't know if because they weren't doing anything for the last year because of COVID or not, but it's going to take us time to revamp and get where we're at. So I think we're going to see consistent appreciation over the next couple of years as the economy gets back to normal. So appreciation is something that we don't always plan for, but when it happens, it's great. And in this corridor, we're talking about multifamily, they haven't necessarily gone up the level that single family homes have gone up. So if they're bought at the right time, especially if it's a distressed property and it needs a lot of work, that's where you build the equity in also, because you're going to buy it low, you're going to fix it up, you're going to raise the rents, the rental value, the cap rate is going to be strong, and the appreciation is going to be there from number one, just gentrifying or rehabbing it, but also from the time factor. As time goes by, things will appreciate. So it's a good market, undiscovered for the most part. Not a lot of people buying multifamily in this corridor, but it's a good opportunity.
Wow, sounds very good. Very good recap, Glenn. You cover all the areas that needs to be covered. So very, very precise presentation, and another great opportunity to achieve cash flow and appreciation potential in your market. So, well, without further ado, thank you for your time. I know you're a very, very busy man. You're doing deals all the time. So anyway, Mr. Glenn Plantone, pleasure talking to you again. We will have other future podcasts about the Las Vegas market. I know you're working on some other projects. We're not going to talk about it right now, but looking forward to working with you for the long term. And we take it from there. All right.
Good stuff. Thanks, SeeWing.
My pleasure, Glenn. Thank you.
Yep. Bye-bye.
Bye-bye.